Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman & Wakefield's #1 investment sales team in New York City.
Hi, I'm John Hageman, sales team manager for Team Knakal at Cushman & Wakefield. Welcome to the Knakal News Network. Today I'm here with Bob Knakal, chairman of New York investment sales for Cushman. So far in 2015, the investment sales market seems like it's been fantastic. Let's dive into the numbers. Tell us what's happening as we approach the end of the third quarter.
Hags, we don't have the third quarter statistics finished yet. It'll be another few weeks before we do. We anticipated that the number of properties sold would probably be down 10 to 15%, but anticipated a new record in terms of the dollar volume of sales. And so far, those numbers are looking like they're going to play out.
You say you anticipated a drop. What made you anticipate the drop?
If you look at the sales market in New York City, for instance, or Manhattan, you've seen that over the past 32 years, the average turnover of the total stock of buildings has been about 2.6%. We were well over 4% last year. We knew that had to revert back.
Bob, you mentioned dollar volume. Tell us about where we're tracking relative to dollar volume.
Dollar volume is going to blow away the previous record. In 2007, there was $62.2 billion in dollar volume of sales in New York City. Last year, we had about $58 billion. And coming into this year, we projected a minimum of $65 billion in sales, establishing a new record. Thus far in 2015, through the first half of the year, we're on pace for about $75 billion of sales transactions. It's really remarkable.
Bob, you mentioned talking about things from a historical perspective, and what's on everyone's mind is where's the market going from here? You know, how long can this market continue? What do you think this means for next year?
Well, that's the million-dollar question. Where are we headed? And I think right now it's very tough to say, and I think it's almost a toss-up. If we look at 1988, we see that was a cyclical peak in number of properties sold, and after that, the market corrected very significantly. In fact, you could argue that the recession in the early 1990s was much more severe on the commercial real estate market than the most recent recession that we went through was. Some product segments lost up to 60% in value in the early 90s, where we averaged a 38% reduction in value during this most recent downturn. And then we look at another year, 1998, where a number of my clients said, the market has gotten out of hand, we're going to sit on the sidelines and wait for things to recover. And if they did that, they would have waited 9 years for a buying opportunity. So what is going to happen after this 2014 cyclical peak? It's very tough to say. We did know that 2015 would be a good year because both 1989 and 1999, years following those peaks, were excellent years. So I think the jury's still out. It's too early to tell. I think that the market is probably safe for the next 2 or 3 quarters at least. But I think we'll have a better indication as we get into the first and second quarter of next year in terms of how 2016 is going to play out. In summary, 2015 is playing out just as anticipated. The number of properties sold is down, and the dollar volume of sales will undoubtedly hit an all-time record this year. History has shown us that the cyclical peak in terms of number of properties sold is generally a great market indicator. It's still too soon to tell what the impact will be on 2016, but we'll have to wait till the end of 2015 to make the forecast for next year.
Thank you for joining us today. Tune in next week for another installment on the Knakal News Network.